today. Okay, we got to start over, huh? Okay.
Yep.
Today is the Money Smart Show, April 20th, 2024, and our special guest, Tom O'Hare, an expert on getting kids into college and all the ramifications of the process of higher education. All right. Here's a disclaimer. This talk on portfolio management and drawdown control is designed to educate investors to identify clues to the market based on stock market data. There is no guarantee that any signal will be timely or accurate. Investors should be aware that the analysis here is designed to inform, not avoid all losses that might occur. So past performance does not guarantee future results. And we're bearish on the stock market. Here's why. Okay, I'm going to show you some things. We reached a shortable correction signal on April 10th, which is last year on Wednesday night. There are four requirements, something called a rate of decline, how fast the market is falling. It is a correction, which the tool we use is to show that the rate of decline is less than 190. The normalized new lows, okay, the new lows are starting to pick up at the top of the market before the sell signal itself. Normalized new lows greater than 60 at the sell signal. So we have a pattern of number of new lows increasing during the decline. And the accelerating new lows calculation, which is based on it's found in the book Before the Bear Strikes, at the signal is greater than 40%. So we have the market's starting to pick up and we have some force to go down. Okay, there are two charts. As you can see, the bottom chart is the short to intermediate market timer tool. Down here, we got a major buy signal. We got invested the next day. And at this point, there was a minor sell signal. So we did not come out. Got a buy signal, major buy signal here. And now we have a major sell signal, the shortable correction. So as you can see, the market is falling here and we're in trouble. Market's in trouble. So here's the market strength indicator was above 3.8. 3.8 is here. When this goes below 3.8, the market's in trouble. Now, to explain this, it uses something called the VIX, the price, advanced decline, up, down volume, and new high, new lows, combines all together, and we get this chart. So it's, you can find this also in the book Before the Bear Strikes. Here's the confidence index. As you can see, is starting to roll over. We have this crossover here of the red line versus the green line. This is all based on internals versus price. Okay, you draw this chart and you get a nice reading of when the market is about to roll over and go down. And that's what we have now. There's the New York Stock Exchange. This is the NASDAQ. So there's a primary indicator that I use. And here's the internals themselves, not based on price, but just see if, and we cross over with a moving average. And as you can see, the New York Stock Exchange index, the internals are crossing over down, and so the NASDAQ. So they're both crossing over down. And that's the reason why we're bearish. The Moon Run report and how you can use it. Okay, we have a few things to say here. It's $10 a month. First month free, and I am Brian Johnson, President and Portfolio Manager. The intent of the Moon Run report is to invest in proven portfolios to generate high returns. Sell out before a bear market hits to get out, and to buy after the bear market is over. So it's a matter of waiting game. You make your hits and you get in. My track record: world champion 2008, Fidelity account up 20%. Over Financial Digest, #2 for the past 12 months. At the end of April, I should be #1 for the past 3 years. Called the bear market in 2008, 2011, 2018, and discovered the tsunami indicator in 2005. What I did is I looked for two things. The market stalls out, which means the investors can't push the market higher, and the indicators, the internals start to weaken. So that's what I did. I looked at 1987, 1990, and 2000, 2002. By golly, it worked. use the same type of formula with the 2008, 2011, and also 2018. So it was a major discovery on my part. And we have some things the Moon Run Report contains. Now you can take a look at this, read it as you wish. Okay, we're going on to the next slide, examining the portfolios. This is how well the portfolios have done on my website since 1999. Back tested, of course, and live tested since whenever they were designed. So the back test 1999 to 2024, almost a 50% compound average growth rate. That's pretty darn good. Maximum drawdown 36%, and that was this in 2008 when the bear market hit. Turnover rate a little bit kind of much, but actually it's not too bad. Minimum average daily volume at least 50,000 shares a day. Doesn't have to be, can be more. And then we search from 15 million market cap to 250 million market cap. Here's a little chart of the graph. As you can see, it's doing very well. Minor cap, 24% a year. Max drawdown, 25%, which is not too bad. Turnover rate, over 100%. 75,000 shares a day minimum. 500 to million to 2 billion, which is between the small cap and the mid caps. Okay, we have a chart here. As you can see, this is doing very well too. It's going upward and onward to the right. Mid-cap portfolio. Backtest from 1999 to 2024, a 25.73% compound average growth rate. Maximum drawdown, very small, 18.84%. That's not too bad. Turnover rate, a little bit about double. Minimum average daily volume, 100,000. Search universe between $2 and $10 billion. So that's what we do. And here's a chart of that. It's done very well over the past. Large cap portfolio, backtest from 1999 to 2024, 23% average compound average growth rate. And then turnover is 138. Minimum average daily volume is 100,000. Doesn't have to be, can be more. I mean, usually they're in the millions. And the search universe is a Russell 1000 large cap Russell index. Here's the chart of this. Altogether, combine the portfolios 31.96% average compounded growth rate, and the maximum drawdown during that period of time, 24.36%. So actually, this is not too bad. I have other portfolios, and they've done very well. So how much $100,000 invested becomes in 10 years? And you can see going down the chart, large cap, mid cap, minor cap, small cap, all performing very well. And a combined average of 31.96%, $100,000 in 10 years becomes 1.6 million. How much $100,000 invested becomes in 15 years? We have this situation where large cap, mid cap, minor cap, small cap, 38 million for small cap, and combined $6 million, $6.4 million. On the YouTube channels, I have featured the book Before the Bear Strikes, Moon Run Report, and the Money Smart Show. So you go to YouTube, enter the Money Smart Show in the search box, and you will see at least 25 shows in there. So they have backtests and information from 1987 to the present, various commentator helpful tips. The shortable correction is the feature education today. Details. It started in 2014. The first investigation was that usually forecasts less than the bear market, 10 to 20% drop. Okay. In 2015, I was with a mutual fund, and the market fell, but I was uncertain as to whether the shortable correction would work, but it did work, and I was left being fully invested. Right now, during that period of time, I did not have the tools to actually negotiate the markets very well. And we wrote it down and wrote it back up again. But the next forecast is when 2020, this was not called at the time, but the back test that I did would have flashed it. Next sequence was 2021 and 2023. Quite a number of signals there. And I have a chart to show you all this. Currently called on April 10th of this last week. So line in 2014, the 50 new lows rule was the shortable correction had one line of code changed in 2022. And all I had to do was change the VIX greater than 20 to accelerating new lows rule greater than 40. And that's what's currently in the book, the second edition. There's only one line of code, but by golly, it took me a dickens to find it. Here's the chart, 2015 to 2016. What would have been, I would have sold here, bought here, the next week sold here, and rode it all the way down to this point. It was a bear market in the Russell 2000, but in the S&P was down only 13% at that time, so it was not a bear market. 2020, the COVID crisis, sell here, accelerate new lows, historical correction, 2/24, 2020. And it would have stayed out. I got out, real time, I got out about halfway down, about here, I think that's what it was. But the buy signal coming up was on April 8th. 2021 to 2023, a mixed type of operation, but really.
Brian, I got a question.
Yeah.
Can you back up the chart? So you right there, is that the signal that got is a sell signal at was that a 137 there?
2/24, 2020.
Okay, so if someone actually trigger sell, start to selling at that trigger, they would have made a pretty bundle with this, right? I mean, that's
yes. The Russell was down 40% top to bottom. Okay, and yes, it would have done well, but I stayed in cash. I just didn't dare trying to call it. Okay, so we have this situation. That's the stop sharing. I'll stop sharing, and we have Tom coming up here to do his thing. Tom?
Hello, how are you?
Okay, you have some things to say about getting people into college and things like that. Please give us your spreadsheet and your presentation.
Yeah, so I'm Tom O'Hare from Get College Going. I work with families and students to try to help navigate the process of finding an affordable college that meets also their personal, academic, and social needs. And let me just share a quick screen here. Hopefully I can get to it. We've been struggling a little. Not sure if everybody can see this. Let me know.
Click on the share screen, please.
I certainly did, but let me go back to it. Wait a minute. Okay, I shared it. Should be coming up in a second.
Yep.
You got it? Okay.
Yeah, it's working.
Right. So from a financial standpoint, the message I wanted to bring this morning is that families do not approach purchasing a college education like they do other consumer goods. The fact is that college education is the third largest investment a family is going to make in their lives. Beyond buying their first home, investing in retirement, college and the financing of higher education after high school is there. It beats buying a car, buying a new sofa, but families don't approach it from that perspective. Few families, unfortunately, right now are saving for college, and they live off of the idea of hopes and dreams. their guidance counselors, their guidance that they receive, even sometimes from the financial world, the financial services world, doesn't include the nature, the notion of saving when the kids are young, maybe sacrificing on certain things so that they have the buying power when they're ready for college. They rely on financial aid, and financial aid is very small in the scheme of things. And right now we've experienced an enormous shift in the process because the government unfortunately introduced the financial aid process, or they call it the FAFSA, very late in the process. And here we now are getting close to the month of May, when students typically make their deposits, and about 2/3 of the families don't know how they're going to pay for school because they haven't received valuable information from colleges, whether it's financial aid through the government or the state they live in, or discounting that's coming from the college themselves. So it is a huge problem right now, and families are dealing with it. What families really should be doing is they should be looking at saving for college just like retirement. And Byron, you know more about saving for retirement and investing money than I do. But if people put money into an account like a 529 or a simple savings account over the lifetime of a student as they approach the age of 18 or 17 to go to college, if in fact college is the place for them to go, they can amass a certain amount of money. Now, it may not pay the entire amount of college costs, but they have buying power. And unfortunately, because we live in a society that bases many things on hopes and dreams, families don't necessarily look at that approach, and they're relying on someone else to help pay. And the true essence of financial aid, as an individual who's been in the business for over 3 decades, continues to be to help supplement a parent's ability to pay for their kids to go to school. So they need to look at saving when they're young so that they can amass a certain amount of resources when it's time to go to school. Families need to take the approach as if they were going to buy a home and assess their capability right now. So if I was working with a family of an 8th grader, I would say, what is your capability to pay for school right now based on all of your resources, what a college might be able to give your son and daughter based on their academics, or what you might qualify for in financial aid. That is going to be the difference that you're going to have to pay. And the sooner families know about their capability, the better they can go out and shop. Because if I can't afford an $80,000 school, even if my son or daughter gets into the school, the school may not be providing the resources, or the government or the state that you live in may not be providing you the resources to pay for that $80,000 school. So the more we know about what our capability to finance the education, just like the budget we would need to know when it comes to paying for our mortgage or our car or even a trip somewhere, the better we are from the standpoint of understanding the process. And the real reality of financial aid is that it's driven by income, not savings and investments. The calculation for investments and assets that a family might be able to save is really 5.6 of the overall methodology that's used in today's process. Income can vary between 24 to 45% of the calculation. So we get scared away sometimes by thinking that our investments and our assets are going to hurt us, when in fact they're not, and we need to save for it. So the other two things really is we have to get away from the idea of buying based on prestige and vanity. If you've read the U.S. News and Report, when it comes out in October and November, it lists hundreds of schools that are supposedly the best schools to go to. Well, the honest truth is those schools pay for that spot in the U.S. News and Report. They ask students to send thousands and thousands of applications to their campus so that they can deny hundreds and thousands of those applications so that they can show that they are a highly selective institution. And we, unfortunately, as consumers, follow that prestige and vanity because we think we're buying into something that someone else is telling us we need. There are about 4,400 schools that fit into that category across the country. They are the buyers. There are about 3,600 that are the sellers. The sellers are the ones that will help families pay some of the resources to go to school. And finding schools is really based on what the need of the enrollment of the college is from the standpoint. So college planning is equally looking at the funding side of it, as well as where I'm going to go and what I'm going to study when I get there. And for me, my world is two areas. I'm an independent college consultant that works with families through my company called Get College Going. And I also run another business, which is an online college planning portal called Pivotal College Years. There are two of us that work in that organization, and we try to take everything that we have, not everything, but 90% of what we know in our knowledge, and put it out there for the family who's looking for a DIY alternative. So Byron, do you have any questions?
We have a few questions here. Why is it that so many consumers are struggling with education costs?
Well, part of it is they don't necessarily understand. Maybe I'll stop sharing here. Pardon me for a second. Part of it is they're not necessarily saving for it. They don't understand the rules associated with it, and they wait too long. It's almost like the whole notion of death and taxes. I don't want to deal with death until I die or my family's going to take care of it. And I don't want to deal with taxes until I have to do it for April 15th deadlines. So as families, we don't necessarily approach the process the same way. So saving for college starts when they're born, a student's born, asking families and relatives to participate. I have 3 grandchildren. Each one of them has a 529 plan. Now there's pros and cons of that particular vehicle to save money, but allows everybody in the household, aunts and uncles, to pay into it as the kids have their birthdays and Christmas, so they can amass a certain amount of money to help. But we don't approach the process as it moves forward. The other dilemma is we as consumers have allowed the price of college to escalate because we chase a certain type of school. We want a certain type of need when we get there, meaning, beautiful dorms, beautiful campuses. I mean, when my youngest son was visiting a school with me and my wife, when we took our second daughter, he was enthroned about the fact that each dining hall had 10 cereal dispensers in each one, so he could get any cereal that he wanted when he went to college. And for him, that was going to motivate him to go. Now, if I go to another school with him and they don't have that 10 cereal dispensers in their dining halls, he might look at that school in a negative way. So we chase each other's wants, supposedly. So colleges over the years have invested enormous in their facilities, their resources, maybe not necessarily their academics, maybe not necessarily their career services, but they have driven their price up because of their need to keep up with other colleges. And what you'll find is that schools are now going to start closing. Here in the Northeast where I am, we've had about 10 schools in the last 3 years that have closed because their financials are not meeting their enrollment numbers, as well as the fact that more and more schools are discounting. The average discount where a college will take money out of their pocket is 50%. So if I'm discounting 50% of my overall revenue and I'm not hitting my numbers, then that's a sure sign that a school might be closing.
All right. Do you assist a student, a prospective student in college to pick a career or to how to determine his career path while he's in college? Is there something that he can do there? I would suppose they have guidance counselors, but is there any type of forward thinking that the student can do to make sure that his career is a success?
Yeah, first they should go into college with multiple options in mind. I mean, unless you really, really know what you want to do when you're done and you pick that major, that's fine. But if you don't necessarily have a 100% or even 80% perspective, I encourage students, especially those that I work with, to look at multiple academic interests as they're entering a school. And use that first year and even second year, because many colleges are now asking students to really, really declare their major at the end of their freshman year or going into the second semester of their sophomore year. use that initial time to experiment on what courses, what academics really, really drive you. A case in point is a lot of students want to be engineers. They go into schools that are 100% engineer driven, and they find out that they're not really interested in that. They might need to leave and transfer because they're no longer interested in that particular program. So it becomes a problem. In the school, students lack to use the resources of career services. Career services is a department where students are paying for that resource to use to explore what careers are going to be available for me when I'm done. And in the second semester of a sophomore year, students should really start getting to know, building a relationship, bring candy, bring resources that you have, questions, so that the career service department can help you start planning out your future. Combine that with your academic advisor to try to make sure you're taking the right courses to learn the skills you might need as you're getting ready to go. But career services is a department that's underutilized in college campuses because, number one, students think that they're going to come looking for them, and career services is designed for students to come to their office to get the services.
Okay, Tom, here's another question. Should everybody be going to college today? Are there alternatives?
The answer is no. Everybody shouldn't be going to college. There is a 20% of a high school senior graduating class, in my opinion, should think twice. Why? Because that number is still the low end of college withdrawals after the first semester of the first year. So education after high school is vital, but it can come, in my opinion, through not only the traditional 4-year, but possibly the 2-year community college route, or even the work and learn, and including skilled professionals. So students and families really need to take a look at not only the affordability and whether that we can pay for school, but also whether we really have had enough after 12 years of education, or we don't necessarily know what we want to do. So going right away because everybody else is going is a condition of what I call the college enrollment herding process, because what 17 or 18-year-old is going to raise their hand in their class and say, you know what, guys, I don't want to go to college? And what family can go into a social or even their family environment and say, you know what, my son and daughter, little Stevie or little Tom, he's not going to go to college right after high school, because the expectation is everybody goes. But the reality is, number one, more and more jobs, we're finding that you don't need a full 4-year degree, maybe a 2-year degree, maybe a credential or a certificate. Or if you haven't called a plumber or an electrician in the last couple months, Byron, we need more electricians and plumbers. So we really need to take a look at what is the best education pathway for the right reason for a student when they're getting ready to leave. Now, of course, we're going to need a lot of teachers and nurses because we've had a lot of those individuals leave, but we really have to be careful in making sure that we're going to college for the first year, for reasons that we need to stay there. Because if we can't afford and we allow our sons and daughters to go and we have to take out a private education loan, it might be $20,000 or $30,000 to pay for that cost, and the student leaves, that's a debt they're not going to be happy to have.
Okay, Tom, great show. Very informative, very happy you came here. And we are at the end of our show. Thank everybody for coming aboard and watching the show today. Matt, do you have anything to say? Thank you, Tom.
So I just post the Money Smart Show YouTube channel. Please join us there as well and share this with everyone. Well, thank you, Tom.
All right, thank you. I appreciate it.
Okay, are we done?
Yeah, thank you.
Okay.